Hey, one rental at a time community, this is for you. We are on separately while Mike is out, but we wanted to continue to produce some content for you guys to listen to, just so you guys get an update on what's kind of going on in the market. And today, actually, in particular, we did this last quarter, but we wanted to talk about how Q3, this past Q3 in 2023, was different than Q3 of 2022. So, we'll just jump right into it. I think the first thing that we wanted to kind of talk about was overall purchase versus refi. So purchase new houses versus refinancing old loans. Dustin, what were our stats last year versus this year?
So in quarter three of 2022, we did 42% of the loans originated were purchases and 58% of the loans were refis. It's obviously flipped given the current market. So in quarter three of 2023, we have done 68% of the transactions were purchases, whereas only 32% of the transactions were refis.
So that number actually surprised us a bit because the number of refis still seems to be higher than what the market is projecting it to be, right? Because I think the stats on the market said that the refis are down like almost 90%.
Yeah.
And it's kind of crazy that we are actually still, 32% of our business is still refinances. We'll get into a little more of why that makes sense. But what's the biggest kind of pointer you think that indicates or why we still have a bunch of refi business going on?
Yeah, I think we're obviously not your typical conventional, owner occupied type lender where the refis on that type of product or homeowner has dried up significantly. A lot of the refis, like we'll get into later, are doing or getting people either out of some bridge debt, out of some hard money, out of a fix and flip type loan or a DSCR loan. And that's the biggest reason is that Convoy does, as you guys know, much more in the investor space, and those refis are going to be a lot higher than your average homeowner that's owner occupying the property.
Yeah, so I mean, the next one, I guess you can kind of talk about
So it
or
kind of
ask.
tails into then our, bridge debt that we were just discussing in 2022. So quarter three of 2022, the amount of bridge debt that we were placing was 26% of our business. This is both purchase and refis, just any type of bridge debt. Whereas in 2023, it was actually 45% of our business.
So the interesting part about this is obviously for our listeners, we know that bridge debt is anything like short-term loan, right? Whether it's a 12, 24, 36-month short-term loan that's not a long-winded 30-year fix. It allows for, it's exactly what it is, basically like a bridge from one point to another. It's not meant to be a permanent solution. However, right now we're seeing actually, interestingly enough, rates are still kind of low for that. It's like we're going as low as 9.99 on a 1 or 2 year bridge, including rehab, not including rehab. And I mean, what kind of resources can we kind of use these products for, or can we provide for our listeners?
So on the bridges, right, it can be anything from acquiring a property that you're planning to, fix up, right, and then either sell or hold. So we'll give you a certain amount, of funds at closing just to do repairs. Or you can do this even like a bridge to sale. This has become a little bit more popular right now where people are in properties that they were planning to fix and flip that now they cannot flip given the current market, so they need to buy themselves some time until that sale. And that's been, I'd say, the most popular recently for sure.
Yeah. And then kind of segueing into our next one, on the bridge to sale aspect, which is getting cash in hand. We, interestingly enough, obviously, with the refi market being where it is, last year, quarter three, we were at 61% of business being cash out refis. And this year, actually, we've actually seen it drop significantly to 21% cash out refis.
So it's just to clarify, it's the
Yeah.
percentage of the refis that we're doing are cash out. 21% of the refis we're doing this year
Correct.
are cash out.
Correct.
And
Yeah.
60% last year of
Last
the
year.
refis were
Yeah.
cash out.
Of the refis. Yeah. Thanks for the clarification. And right now, a lot of our cash out refinances have been largely like DSCR, debt service coverage ratio cash outs, because a lot of clients have tipped, like they basically capped out on their equity, and they can't really, they don't have any way, or sorry, excuse me, debt to income ratio, and they have no way of tapping into their equity to pull some cash out. So they're turning to us and being like, hey, I have this equity in there. How can I pull this money out? And a big popular program is obviously the debt service coverage ratio program, allowing clients to not use personal income to qualify. And that we're still seeing. I kind of heard some crazy stats, like or not stats, but rates from clients, and they're like, "Hey, this other guy's quoting me 9.5%. This other guy's quoting me 10%." I'm like, that's crazy, because we're still being able to get into the low sevens on
Yep.
debt service loans at 30-year fixed on cash out loans, and that's like blowing people's minds, because they're like, what do you mean you can still get in the low sevens? Which, it's crazy we're talking about that now, but the rest of the market is so far beyond where we are right now in terms of rates. I think it's a very good opportunity for a lot of clients, especially if you haven't moved on something right now. Just, reach out to us, let us kind of guide you in the right path, because we have more options, since we do so much more volume than a lot of other shops across the nation. So no one's really going to be able to beat us on. I haven't seen anyone be able to beat us on rate or price, essentially, on a DSCR loan, especially.
No, and I would agree with that. I mean, the thing that I don't think a lot of consumers or investors realize is that on DSCR loans, it is all going to be based on the lender that you're working with and their relationship with the fund or the insurance group or the family law office that they're selling these notes to on Wall Street, right? The rate differences that you see on conventional loans are going to be very, very small or identical because everybody is getting their funds from the same cow, I like to call it, which is Fannie or Freddie or the FHA, VA, etc. But on DSCR loans, we really urge our clients to shop because they are going to be sometimes, and like John brought up, rate differences between 2.5% sometimes.
Yeah, shop with us. Yeah,
Yeah.
obviously. So, I mean, if you want to talk about the next point.
The next one, so this was interesting because we didn't see that much of a change with regards to in Q2 of 2022, 24% of the refis that we did were getting clients out of hard money or bridge debt, into something long term, right? In 2023 or Q3 of 2023, that number pretty much stayed identical to 25%. So I don't know. What do you think was the reason for that, or is it just maybe the market hasn't moved too much that people are still doing it? Or
I think there's still opportunities on the bridge debt, but a lot of people have been trying the market, right? They're constantly listing their properties and being like, "Hey, I really still want to try to sell it," and then they're realizing, "Okay, maybe I really can't sell it," right? So now we're getting a lot of the stragglers that really try to list it for a long time, but then they were like, "Oh, I can't really sell it anymore, so I really need to refi out. My money's coming due," and the reason we're kind of seeing this, I think, gradual increase but also stabilization is because a lot of this bridge debt is like 12, 18, 24 month, and people try to wait kind of towards the ninth or the 10th month to kind of do this.
yeah,
And we're kind of seeing that kind of, obviously 9 months, 9 months, 9 months, 9 months. Now we're seeing it kind of trickle down, and a steady flow of this bridge debt having to turn into long-term debt, because now they can't get out of what they're in right now, and they're like, okay, well, now I might as well just keep it and hold on to it. So we're seeing a lot of refis do that. And what's actually been kind of the biggest, I think, help for our clients also on the flip side is that we can do refinances into 30-year fixed debt from anywhere between 0 months to 3 months of seasoning.
it's huge.
Yeah. So everyone else in the market is still at 6 months. And we have options to go 0 months. If you do the bridge loan with us, and then the second loan ends up being not as good, but if timing's an issue, then you can do 0 months. Or you can do 3 months, which I think is already, it takes 3 months to rehab a property.
Yeah.
So you might as well do the 3 months, and then you can then refi into using ARV. That's the most important part. Using the ARV to do a cash out loan and take back a lot of the money that you spent to rehab the property. And I think that really helps a lot of our clients kind of achieve what they want.
Yeah, and then what you touched on, I mean, it takes 3 months, but for your average investor listening or your experience, it's the note date to the note date. So you may close on a property, today, you may be done with the rehab in 2 months. Well, we can start the process now, get all the kind of paperwork, the appraisal, all that done, and we'll just set the closing date 90 days away from when you actually purchased and got the note initially closed.
Yeah. And I mean, kind of on the side of rehab, ground up construction we've been seeing is increasingly popular. There's a lot more people doing that because there's a housing shortage still, and a lot of people are finding opportunity in new construction, new development projects. And for that, I mean, in 2022 quarter three, it was like 2% of our loans. Now we're doing more like 5%. So or this past quarter. And I think a lot of that is due to the fact, again, like more people are finding and trying to look for better deals, great deals to, buy land at cheap, build on it. Because at the end of the day, if you want to, people are profiting more from that too. They can either sell it off as individual units parceled out or build like an apartment complex or a multifamily that allows for them to kind of customize how they want the rents to be in whatever market they choose. Um, and even for that, like we're still getting pretty good terms. If you're at like a low leverage, meaning like 60 to 65% loan to cost, we're seeing prime rate plus a half on some of our banking products. And then also, if you're trying to go more like, hey, I don't want the fuss of a banking product and I want high leverage, we're going up to like 85, 87.5% loan to cost and, as low as like 10 and a half, which is, in this market, it's kind of crazy because most lenders across the board for ground up construction is doing like 12, 13%. I think that's kind of what I've been seeing across the board. So obviously we just doing a lot of volume, so we're securing that low rate, but it's allowing clients to kind of tap into a different side of the market that they haven't been able to tap into before, to find new opportunities. Yeah.
Yeah. So our last statistic that we wanted to share was the amount of HELOCs and second position mortgages. Um, in 2022 or quarter three of 2022, it was still just barely rolling out. So only 3% of our business back in quarter three of 2022 was for second position loans or HELOCs, whereas in 2023, 11% of our business is either second position, mortgages or HELOCs. Now, the important part that we wanted to share is this is not just for your primary residence, like some people may still think, but for investment properties as well. And what's nice is on this product, we have a multitude of ways to get you qualified, whether it's primary or investment, using your typical kind of conventional underwriting with full income docs, W-2, tax returns, etc. Or we even have some stated income ones, no income doc ones, DSCR ones. So a lot of our investors are getting creative with how you can qualify and how you can actually get a second without, refiing, touching your 2.5 or 3% first position mortgage.
Yeah. And I mean, we talked about a lot of different numbers, but obviously this goes to show you, and Mike always says that, we just have a lot of options, right? And because Dustin and I we're actively originating while running Convoy, and we have other loan officers that we manage. We have our finger in the vein of the market. So we're seeing very actively what the market is doing, and we're getting a lot of word from, higher executives from other firms and funds that are telling us kind of like how the market is going to move and what they're expecting. So, if you want to reach out to us, go to convoyhomeloans.com. Let us know you came from Morat so you can speak to one of us. But again, we appreciate the community so much for everything you guys, have kind of reached out to us for, and we hope to continue to help you guys in the future. Any closing comments?
That is it. Thanks, guys.
Thanks, guys.